Tonight we're going to cover Chapter 7, which deals with property income. Now, when we talk about property income, we're basically talking about income that is earned mostly from investments or where little effort is required to produce the income. So some common examples of property income: interest income. You buy a term deposit, you earn interest income, you don't have to exert much effort to earn that income. Dividend income, you buy shares in one of the banks, you get paid dividends, you don't have to exert a lot of effort to earn the dividend income. Rental income, you buy rental property, same with royalties. You don't need to exert a lot of effort to earn those types of income. So we're going to sort of focus on property income later. What we're going to do first then is talk about the deductibility of interest. So when a business borrows money, they pay interest, and there's sort of some basic rules as to when interest is deductible. So the income tax rules say that interest must be calculated on a day-to-day basis. So interest is basically accrued every day the loan is outstanding. The interest must be calculated on a principal sum, so usually the amount that is borrowed, and you, the borrower, have a right to use that principal sum. So those are sort of the basic rules of when interest is deductible. And there's also some additional clarification as well. The interest that is paid must relate to money that was borrowed to basically earn a source of income. And so you borrow the money to help with your business, you borrow the money to help generate rental income. And so that's sort of what that first requirement says. Or the interest could relate to an amount that was borrowed to buy property, and that property was used to earn business or property income. So a company borrows money to buy some equipment. They use that equipment to earn business income. The interest would be deductible. Individual buys rental property. In order to buy the rental property, they must borrow some money from the bank, take out a mortgage. They use that rental property to earn rental income. Once again, that interest would be deductible. So it's pretty sort of straightforward when interest expense is deductible. Now, in the textbook, they go through some court cases that relate to interest deductibility. And so we're going to review just a couple of the court cases. You don't need to know the court cases in a lot of detail, just sort of know the main takeaways. The first one we're going to talk about is the Singleton court case. And this looks at direct versus indirect use of the borrowed money. So let's talk about the Singleton case. Mr. Singleton was a partner in a law firm. So this is Mr. Singleton here, drawn with a circle. So usually when we draw diagrams for sort of tax planning purposes, individuals are drawn with a circle. Now, he was a partner in a law firm. And so this partnership down here, this is the law firm. And partnerships are drawn with a triangle because they're a flow-through entity. You probably learned in your accounting classes that partnerships, all the income flows to the individual partners. And if you remember from the very first class we had, we said that a person is subject to income tax here in Canada. A person is an individual, a corporation, or a trust, but partnerships are not a person because all the income from the partnership flows to the individual partners. So that's why it's drawn with a triangle, because they're known as a flow-through entity. So let's sort of look at what happened with this Mr. Singleton. So I kind of just broken the steps down into steps 1 to 5. So what happened was Mr. Singleton was a lawyer in a law firm. What he did first was he withdrew money from the partnership, and that created a negative capital balance. So in your accounting classes, when a partnership is formed, the partners will contribute money to the partnership. So when the partnership is formed, Mr. Singleton likely contributed money into the partnership, and all the contributions are tracked in their capital account. When money is taken out, that will reduce the balance in the capital account. Their share of the income and losses also get attributed to the capital account as well. So step number one, Mr. Singleton withdrew money from his capital account from the partnership, and that created a negative capital balance. So that basically means that he's in a negative position. He owes the partnership that amount of money in order to bring it back to zero. Step number two, he used the money that he withdrew from the partnership to buy a personal house. So he used the money to buy a house for his personal use. So that was sort of step number two. Step number three, basically the partnership said you must replenish the capital account because it was in a negative balance. So Mr. Singleton borrowed money from the bank. So that was step number three. So step number three, he took a loan from the bank. And then step number four, he basically used the money from the loan to repay the capital account. And then basically the very last step was he deducted the interest from the loan against his partnership earnings. And so he basically argued that, so this is sort of what Mr. Singleton argued, that the direct use of the loan was to invest in the partnership. Thus, the interest is deductible. So if you sort of look at the direct use, what we're saying here is that the loan went directly from the bank to Mr. Singleton, and Mr. Singleton used it directly to fund his capital account, his investment in the partnership. So that's sort of what his argument was, that he could deduct the interest. The CRA basically denied the interest expense, arguing that the indirect use of the loan was to buy his house. So if you think about it, what they're sort of saying is that you can sort of just sort of eliminate steps number 1 and 4. And so if you sort of put the house here as step number 2, if you sort of eliminate steps number 1 and 4, indirectly, he just used the loan to buy the house. And so that's sort of why the CRA denied the interest expense, arguing that it's the indirect use that should prevail. This sort of gets into sort of an argument of, whether the substance or the form should prevail. If you sort of think about it, the substance of the loan was to basically buy the house. But if we look at sort of the direct use, which is the form of the loan, it was to fund the partnership. So this dispute went all the way up to the Supreme Court. And so the Supreme Court, basically, that's sort of the last court that's available to hear the cases. And so when it goes to the Supreme Court, that's sort of the final decision. And so the Supreme Court basically ruled in favor of Mr. Singleton and basically said that the direct use prevails. So this was quite sort of a interesting court case because, sort of a lot of the people in the tax community said, well, the CRA basically makes a good point because the substance of the loan, the indirect use, was basically to buy the personal house. The loan basically was used to fund his purchase of the house. The only reason he did steps 1 and 4 was so that he could argue that the direct use of the loan, the money from the bank went directly to the partnership, so that he could sort of use the argument that the direct use should prevail. And that's sort of what the Supreme Court ruled in favor of Mr. Singleton. So this was quite a number of years ago. This is actually a local law firm. So Mr. Singleton was sort of based here in Vancouver. This was a court case that went all the way to the Supreme Court. And to this date, the CRA hasn't done anything to introduce new rules to sort of overturn this decision. So when sort of the court sort of rule or make a ruling, that's sort of the way the laws are interpreted until the CRA or the government makes any changes to the laws to basically overturn this sort of decision. So this was sort of, once again, an interesting court case because it basically looked at the indirect and direct use of monies that is borrowed. And ultimately, the Supreme Court said the direct use prevails. So Mr. Singleton was allowed to deduct the interest expense from his partnership earnings. Once again, this is sort of an oversimplification. This is only looking at sort of the main steps. Obviously, there was probably a lot of other additional factors that came into play as well, but that was sort of the overview of this court case. Any questions about the Singleton court case? Now, the next court case deals with a Canadian company called Lutco. And this sort of looks at again, sort of at the purpose of the loan, and also sort of looks at the income that was generated from the loan. So let's sort of look at this diagram here. We're
Hey,
focusing on this.
Ronald,
Mhm.
I'm just curious. No, I had a question about the previous
Sure.
example. So, and now is that a generally accepted practice of people taking out their share of the partnership, the capital balance, or is
So,
it
so
not
once
practiced?
again, this is something that was quite a number of years ago. And once again, we were not going through all the details here. So there was definitely a lot more details that was probably involved that's not talked about in the textbook. And so from what I understand, there are still some accounting firms that will sort of set up this sort of structure so that partners can still sort of go through the steps to make this happen, make this plausible. But once again, it's a fairly detailed structure. This is just a very simple overview of it. But from what I understand, there are still some accounting firms that will work with partners that are in a partnership to make this happen.
Okay, good to know.
Yeah. Any other questions? And this is sort of what a lot of tax accountants do, not specifically this specific setup, but if you become sort of a tax senior manager, a tax partner, a lot of the times you're looking at these court decisions and seeing how they can benefit your clients. And so this gets into very sophisticated tax planning. So don't think it's just as simple as these sort of 5 steps here. There was a lot of details that obviously we can't cover because it was a very lengthy court case. It went all the way to the Supreme Court. But from what I understand, there are currently still accounting firms that will sort of look at this decision and see if it will fit with some of their clients. And if it does, they will sort of set up the structure and the steps to make sure it's done properly. The next one we're going to look at is called the Lutco decision. So Lutco was a Canadian company. And so what Lutco did, step number one, they basically borrowed money from the bank to invest in sort of 2 subsidiaries. So step number one, Lutco borrowed money and invested. So that's the step number one. We'll leave that as step number one. They borrowed money from the bank and then they used the money to invest in 2 subsidiaries. So step number one, Lutco borrowed money from the bank, and then they used that money, step number two, to basically invest or fund these 2 subsidiaries. Over the years that this loan was outstanding, and the loan, I guess, I'll put that down here, was a $7.5 million loan. Over the years, Lutco paid and deducted interest of $6 million. So the loan was outstanding for a number of years. So they paid interest on the loan, deducted the interest on the loan, which was $6 million. And the subsidiaries basically paid Lutco dividends. So sub 1 and 2 paid dividends to Lutco, totaling $600,000. And then step number 4, eventually Lutco sold the shares of sub 1 and sub 2 for a capital gain of $9 million. So this is sort of what Lutco did. So over the years, Lutco had dividend income. And so they declared the dividend income of $600,000. Over the years, they deducted the interest. The interest expense was $6 million. And then when they sold the shares, they had a capital gain of $9.2 million. Once again, only 50% of that's taxable. So for tax purposes, the taxable capital gain was $4.6 million. I'm just going to do just a quick total here, and just to sort of look at the overall impact. So the overall impact, oh, hold on, it doesn't seem right. Yeah. So the overall impact was negative $800,000 because of that huge interest expense that was deducted. The CRA came in and said, we don't agree with this. So the CRA basically said, interest is not deductible as main purpose of loan was not to earn income. So remember, capital gains is still part of net income for tax purposes, but the CRA argued that you took out this loan and the main purpose was not to basically earn dividend income. So the main purpose was not to earn property income, specifically dividend income. You were basically hoping to sell the shares for a large capital gain. So the CRA said, well, you can't deduct the interest. We'll let you reduce your, increase the cost base of the shares, but we're not going to let you deduct the interest against the dividend income. So this is sort of the CRA said. You still have to declare the dividend income of $600,000, but the interest expense is not deductible. Instead, when you calculate your capital gain, which is $9.2 million, you can capitalize the interest, meaning that you can add it to the cost of the shares. And so that $6 million would reduce the capital gain, not dollar for dollar against the dividend income. And so the capital gain then should be $3.2 million, and 50% of that's deductible. So let me just move this over here. And so your capital gain will go from 9.2 to 3.2 million. 50% of that's deductible, or 50% of that's taxable, which is 1.6 million taxable capital gain. And if we sort of look at the impact of what CRA said, we're going to get an overall increase of 2.2 million. And so when you sort of look at the difference here between the negative 800,000 and the 2.2 million, that's basically a difference of 3 million. And the reason that difference is because what the CRA says is that the 6 million should be deducted when you calculate your capital gain, add it to the cost of the shares that you're selling, and therefore only 50% of that 6 million will end up reducing the taxable capital gain because it's only 50%. We have to multiply it by 50%. Whereas here you get to deduct the full 6 million. So under Lutko's calculation, dollar for dollar, all 6 million was deducted, but the CRA said that 6 million should only adjust your capital gain. And because only 50% of that is taxable, only 3 million of the interest ended up getting deducted when we calculated the taxable capital gain. So that's sort of why there's this big difference of $3 million. And so again, this sort of court case went all the way to the Supreme Court. And the CRA's argument was that the main purpose of the loan was not to earn property income, because the property income that was earned was so minimal, it was such a small amount compared to the huge interest expense of $6 million. And so once again, went all the way to the Supreme Court. And the Supreme Court basically said that a loan may have multiple purposes, and basically ruled in favor of Lutko. So yes, the loan could have been used to buy shares to hope that the shares would increase in value. Another purpose was to earn dividend income. The amount of the income is not really that relevant. So again, the Supreme Court ruled in favor of Lutko. So both of these decisions were in favor of the taxpayers. And that's sort of one of the reasons why they were sort of talked about in the textbook, just to sort of give students an idea that, yes, we do have the Income Tax Act and the rules are written, but when it comes to interpreting the rules, that's sort of where there's sort of sometimes this gray area. And that's sort of where disputes happen between taxpayers and the CRA. And if they don't agree, it can sort of go to court. Usually we'll go to the tax court first, then to provincial court. And then if either party wants to approach the Supreme Court may or may not hear the court case. But in these two examples, they did, and both of them were in favor of the taxpayer. And so once again, we're just sort of going through the main sort of steps. There were definitely a lot of details that was not talked about in the textbook, because these are court cases that probably last a long, long time, a number of weeks. And so just to sort of give you an idea that if you do pursue a career in income tax, you will spend a lot of the earlier years doing tax returns. But if you get to a point where you become maybe a tax specialist, a senior manager, a partner, you will be sort of looking at court cases, and the court cases happen all the time. So when court cases do happen and it affects the income tax, then the tax specialist will usually look at the results and see if there is some way they can use the results to maybe help some of their clients. Any questions about these two court cases? The next part that we're going to look at still deals with interest deductibility. One of the rules they talk about in the textbook is this disappearing source rule. What if the loan can no longer be traced to a source of income? And so remember we said that interest is deductible if you use the money that you borrow to earn a source of income. Well, what if you borrow money to buy some shares? And let's say those shares end up dropping in value, and you think, okay, I need to sell the shares before I lose all my money. So you sell the shares at a loss, but there's still some loan outstanding. Can you still deduct the interest even though the shares have been sold? The source has disappeared. And the disappearing source rule says, yes, you can still deduct the interest even though you sold those shares. What I want to do then is sort of go through this question, some cases that relate to interest and whether or not the interest is deductible. So each of these cases are independent, and our job is to determine whether or not the interest is deductible for income tax purposes. So the first case, this individual borrowed $700,000 using her condo as collateral. So she basically borrowed the money. She gave the bank or the company that she borrowed from her condo as collateral in case she doesn't pay it back. She used the money to buy some high-tech shares, and she thought they were going to double in value. Now, there was no dividends anticipated during the period that she's holding the shares. However, instead of doubling, the shares lose 60% of their value. And then she sold the shares during the year for 280,000. So she basically lost a bunch of money. She bought the shares for 700, she sold them for 280. And so when she got the 280, she used that to pay down the loan. So there's still 420,000 of the loan outstanding. And she's not sure whether she will be able to pay off the remaining amount. She's still being charged interest. Can she continue to deduct the interest on the outstanding loan? So this is a prime example of that disappearing source rule. So this disappearing source rule that we just sort of talked about applies directly to case A. So even though the shares are sold, she can continue to deduct the interest on the loan. So once again, that's just sort of an example of that disappearing source rule. And so yes, the interest would still be deductible. So as we're going through these cases, if you have any questions, feel free to just sort of jump in and ask them. If we move to case B, this individual borrows 850,000 to buy a duplex. And he's intending to rent out the property. But after he bought the property, he was unable to find any tenants willing to rent either side of the property. So a duplex, side-by-side duplex, there's 2 units for rent. He couldn't find any tenants to rent the duplex. So he then learned that there was an excess supply. That's why he wasn't able to rent out the duplex. So he sold the duplex at a loss of 600,000, or at a loss. So he sold it for 600,000. He bought it for 850. What he did was he used the 600,000 to buy 2 new properties, the first for 250 and the second for 350. And so then the question is, can he still deduct the interest that's being paid on the original loan? And so once again, obviously the bank would have had to sort of agreed that if he sold the duplex and that he could sort of use the money to buy 2 new properties, because obviously the duplex was the security on the original $850,000 loan. So provided that the bank agreed to let him use the proceeds to buy 2 new rental properties, could he still continue to deduct the interest expense? And this is sort of one, if I just sort of make some notes here for case B, the argument is that the loan is now traceable to the 2 new rental properties. So this is not a disappearing source rule. This is basically just saying that the loan can now be traced to the two new rental properties because they used the proceeds from the sale of the duplex to buy the 2 new rental properties. So the interest is deductible. The only thing is, though, if you think about the original loan was 850,000, but the value of the 2 new rental properties is only 600,000. So what he could do is sort of prorate the interest expense and part of the loan to each rental property. So what I mean by that is we look at rental property number 1. One is worth 250, the other's worth 350. So for rental property number 1, he could say that we'll take 250,000 divided by 600,000. multiply that by the 850, and then this amount of the loan will relate to rental property number one. So that's how he could sort of figure out how much of the interest he would deduct against rental property number one. And then for rental property number two, it was worth 350. The total of both was 600. And so he could use this portion of the $850,000 loan to allocate the interest to rental property number two. So once again, yes, the loan is traceable to the new rental properties. So yes, he is able to still continue deducting the interest. Case number C is similar, but with sort of different amounts. So let's look at case C. So case C, the taxpayer buys a rental property that is 100% finance. So he bought it for $575, took it out a loan for $575. Several years later, the balance of the loan is now $500. He sells the property for $825 and then uses the $825 to buy two new properties, one for $275 and one for $550. He didn't use any of the $825 to pay down the loan, so the loan is still outstanding for $500,000. And so once again, this sort of similar to the previous one, the loan of $500,000 can now be traced to the two new rental properties so that he can still deduct the interest. But with this one's a little bit different because the amount of the loan doesn't exceed the total value of the two new properties. The two new properties have a total value of $825. So let me just sort of show you how he could deduct the interest in case C. So the answer is yes, the interest is still deductible as the loan is traceable to the two new rental properties. And what he could do is he basically has some flexibility. So there's sort of some flexibility here as to how he deducts the interest. He could basically say that the loan applies entirely to the $550,000 property because that's more than the value of the loan, and deduct all the interest against the rental income of this first property. Or if you wanted, you could sort of prorate the loan and interest expense. And so once again, he could basically prorate it and say for the first one, he would take the 275, divide it by, what was the total of both properties? It was 825. And then multiply that by the $500,000 loan, and then deduct that portion of the loan against the first property. And then for the second one, 550 divided by 825. And then use that portion of the $500,000 loan, the interest on that portion, to deduct against the second property. So there's sort of some flexibility with this one because the value of the loan is lower than the overall value of the two new rental properties. And let's look at the last one. The last one's a little bit different scenario. This taxpayer wants to buy a Rolls-Royce SUV, which cost $525,000. His bank has agreed to finance the purchase with a loan at interest of 7.5%. However, he can borrow the same amount using a margin loan against the investments in his trading account. So what this means is that he has sort of a trading account and he owns a bunch of stocks, and he can take a loan using the investments that he has in the trading account basically as collateral, and that would reduce his interest to 4%. And because of that, he's going to take advantage of this lower interest rate and take the loan out of his using his investments as collateral and purchase the Rolls Royce using that loan because it has a lower interest rate. Now he's assuming that he can claim the interest as a deduction because it's connected to his trading account where he is, trading shares and earning income. And so this actually relates to that Singleton case. What is the direct use of the loan? The direct use of the loan is to buy the Rolls-Royce SUV, which is for personal use. Therefore, the loan interest is not deductible. So for case D, the direct use of the loan is to purchase the personal SUV, thus interest not deductible. So once again, this sort of ties to that Singleton court case that we talked about at the beginning, where we look at the direct use of the loan. And because the direct use was to buy a personal asset, the interest is not deductible, even though he used his trading account sort of as collateral to basically give him such a low interest rate. Any questions about this assignment problem? So now we're going to move on to the income side. So we've dealt with interest expense deductibility. Now we're going to move on to interest income. So what are the rules with respect to interest income? If you are a corporation or a partnership, you have to use the accrual method. So just same as your accounting class, where you learned about the accrual method, even though you haven't received the interest, if you earned it, because interest is accrued day to day, you have to include it in income. So that would apply to corporations and partnerships. Now for individuals, the textbook talks about this modified accrual method. So I'm going to sort of explain this modified accrual method. In terms of where you will see this modified accrual method, usually you'll sort of see it with respect to private loans or private investments. So you're not going to see it if you invest in a GIC or term deposit at the bank, you're going to get your T5 slip every year. So this modified accrual method, usually you'll see it when there's sort of a private loan being made and the interest is sort of paid irregularly. So it's not like a term deposit where you get paid the interest maybe at the end of the term or sort of the end of every year. This sort of would usually only be seen with respect to maybe private loans that are done sort of between individuals and maybe corporations, but not sort of in your typical investment at the bank. So let's look at this example together. There's this individual that invests money in this investment contract. So basically they're loaning money and the contract starts on June the 1st, 2024. We basically invest 80,000 with a rate of 7%. The maturity will be in 6 years. So 6 years will be May 31st, 2030. And even though the interest is calculated annually at 7%, the payment of the interest will happen one payment on August 31st, 2027. That's going to be for the first 3 1/4 years. Remember, it's a total of 6 years. And then the final payment of interest will happen at maturity, and that's for the last 2 3/4 years. So let's just sort of do some calculations first of all. We have this investment contract. So the investment that he made, or the taxpayer made, was 80,000. Going to earn 7% interest a year, which is 5,600 per year. This is over 6 years. So the total interest will be 33,600. Now, we're just going to assume simple interest. We're not going to assume compound interest. And so if you think about this investment contract, the first payment will be made on August 31st, 2027. It's going to be for 3 1/4 years. And if it's 5,600 per year, that first payment of interest will be for $18,200. The last payment of interest will be paid at maturity May 31st, 2030. This is going to be for the last 2 3/4 years times 5,600 per year. So that last payment of interest will be for 15,400. And what you'll notice that the total is the 33,600. So the total interest will be 33,600. Given this investment contract, the interest payments will be done in 2 payments, 18,200 and then 15,400. So what I want to sort of show you first then is what would be reported on a cash basis. So if we were looking at a cash basis, the first payment will be made in 2027. That would be 18,200. The last payment will be made in 2030, 15,400. But what you'll sort of see is that the total, I'll just do the total down here, is the 33,600. But we know that cash basis is not allowed for accounting. So if we were doing this for accounting purposes using the accrual basis, let's sort of figure out what the amounts would be. Every year is 5,600, except for the first year. Remember the first year, the investment started on June the 1st. So that's going to be 5,600 times 7 over 12 months. June through December, that's 7 months. So for the first month, for the first year, if we were doing this under accrual accounting, we would have 3,267 because it's only 7 months. Every year thereafter, it would be 5,600 because we have full years under accrual basis. But then for the last year, once again, it would only be for 5 months, right? Because remember the first year, it was a part year. For the last year, it would only be for 5 over 12 months times 5,600. So for that last year, we would have 2,333. Now, if you add up the totals under accrual accounting, we would also get 33,600. So we're going to get the same total under this modified accrual method, but the yearly amounts may be slightly different. So we looked at cash basis. We know that cash basis is not allowed for accounting. If we were doing this for accounting purposes, we use accrual accounting, and those are the amounts we would have to include as interest income every year. Let's talk about this modified accrual method. Now, the modified accrual method will be a bit of a benefit if the investment contract is structured sort of the right way. So let's look at 2024. The way the modified accrual method works is in the first column, we determine whether there's an anniversary date in that year. So if we think about 2024, when is the first anniversary? The first anniversary is not till 2025. So in 2024, we do not have an anniversary date. So there's nothing receivable because there's no anniversary date. So they looks at if there is an anniversary date, how much is receivable from the last anniversary date. But because 2024, the investment just started, there's no anniversary date, so there's nothing receivable for that first year. Then we add any amounts that we received. Well, we didn't receive anything this year because once again, if you look at the cash basis, our first payment was not until 2027. So 0 in the second column. The third column, we will minus anything that have already been included. So we will sort of minus any amounts that are talked about in this line that are already included. But once again, pretty straightforward. There's nothing in the first 2 columns. So there's nothing to be subtracted. So for the first year, this taxpayer would not have to include any interest income on their tax return. So a bit of a benefit because under the accrual method, they would have had to include 3,267. Then we get to the next year. In 2025, is there an anniversary date? Yes, the first anniversary date, May 31st, 2025. How much is receivable from the last anniversary date? Well, this is the first year, so the total receivable would be 5,600 up to the first anniversary date. Did we receive anything this year? No. Was this 5,600 previously included? No, because this 5,600, if you think about it, this is from June 2024 to May 2025, right? June 1st, 2024 to May 31st, 2025. So that was not previously included in income, so we don't have to make any adjustments. So 5,600. Then we move to 2026. We look at the next anniversary date. So that would basically, we will look at the next 12 months, June 2025 to May 2026. So the next anniversary date would be May 31st, 2026. How much is accrued from the last anniversary date? Well, another 12 months of interest, 5,600. Did we receive anything this year? Nope. Was this 5,600 previously included? No, because it's a different time frame from the amount we included in the previous year. It was a different anniversary year, and so nothing to deduct. So 5,600. So what you guys want to see is that once we got past the first year, the amounts are similar to what would have been included under accrual accounting. Then we get to the 2027 year. So the next anniversary date would be from June 2026 to May 31st, 2027. Another 5,600 has accrued, but this is the year we got paid the 18,200. Now the 18,200, if you remember, was for the first 3 years and 1 quarter. So this 18,200 represents everything from June 1st, 2024 to August 31st, 2027. So the first 3 years plus a quarter. A quarter of a year is 3 months. So everything for the first 3 years plus June, July, and August. Now, if we add this first two, the challenge comes with, what do we subtract here? Now, if you think about it, this 18,200 includes this 5,600, this 5,600, and this 5,600. So we basically have to subtract 3 times 5,600 here. So 5,600 times 3 is 16,800. So we have to subtract that because included in this 18,200 is the first 3 years, which we have already included. So we can't double count that amount. So we should subtract 16,800. And so what would be in our total column? In our total column, 5,600 plus 18,200 minus 16,800, we get $7,000. This $7,000 represents the amount from June 1st, 2026 to August 31st, 2027. It's for basically 1 year and 3 months, or a quarter. So everything up until August 31st is now included in income. And that's because we actually received 18,200. So because we actually received the cash of 18,200, and that brings us to August 31st, 2027, we now have to include all of that into income. Any questions about the 2027 year? So if you think about it, it's basically 5,600 plus 0.25, so 5,600 times 0.25 that's going to be 1,400. So that's what those 3 months is worth, is the 1,400. Now let's move to 2028. 2028, the first column, how much has accrued from the last anniversary date? Well, another 5,600. So this would be from June 2026 to June 2027 to May 2028. Did we receive anything this year? No, under cash basis, nothing was received, so 0 in this column. Now we have to figure out how much we have to deduct in the last column. Now, if you think about it, this 5,600 includes everything from June 2027 to May 2028. We already included 3 months here. So remember, this 7,000 included everything from June 1st, 2026 to August 31st, 2027. So there's this overlap of these 3 months here. So the first 3 months of sort of this period here, we now have to subtract it. So basically the June, July, and August 2027, we now have to subtract it, which is that 1,400. So then the total we would include in 2028 is 4,200. So it gets a little bit confusing, but hopefully sort of the dates that I've sort of listed here sort of helps you sort of understand how we're sort of making these calculations. So if we're looking at 2028, we include 4,200. This will bring us all the way up to May 31st, 2028. So now we've included everything to May 31st, 2028. Then we go to 2029. Once again, how much is accrued from the last anniversary date? Another 5,600. So this represents June 2028 to May 2029. Nothing was received. We don't have to make any adjustments. So 5,600. And then we get to the last year. And once again, we have to do another anniversary date accrual. So this time we're looking at 5,600 from June 2029 to May 2030. That's when the contract matures. And in this last year, we did get 15,400. But if you think about it, this amount here brings us to the maturity date. The 15,400 that we received is everything from September. Remember the last payment we got brought us to August 31st, 2027. So the last payment we're getting of 15,400 would be everything from September 2027 to May 2030. This 15,400 has already been included. And so in the final column, we're going to deduct the 15,400. And so that will leave us with just 5,600 to report in the final year. Now, I'm going to just total up this column here, just to sort of show you, let me just bold this, that we will still get 33,600. So if I total up this column here, we're still going to get a total of 33,600. So once again, you don't see this in sort of everyday term deposits, GICs that you'd make at the bank. You would probably see this sort of in a private loan. I think the one time I saw it was like a construction company needed some money, and so a loan was made from this wealthy individual to this construction company that was building a residential property. And because it was a construction company, they didn't have regular cash flows. So the interest was structured in a way that payments were made for interest sort of at irregular points in time. And that was sort of the one time that I did sort of see this modified accrual method that was being used to once again help the individual taxpayer that made the loan to sort of calculate the right amount of interest income that they had to record on their tax return. And it would have benefited them because under the accrual method, they would have had to sort of report the interest income earlier. Any questions about this example here? So just as another example that you can sort of do on your own when you're preparing for the midterm, you can sort of look at this example in the textbook that goes through a similar example with sort of different amounts on page 406. So that's sort of interest income. Now we're going to move to rental income. So with rental income, generally the accrual method applies. However, in the CRA sort of rental income guide, they do say that you can calculate rental income using the cash basis, provided the amount would be very similar under the accrual method. So the CRA sort of rental guide says you can use the cash method to calculate your rental income to report on your tax return, as long as it's going to be pretty much the same or similar, comparable to the amount under the accrual method. So that's sort of the one sort of difference here is that you can use the cash basis, but once again, provided that it will provide similar results as the accrual method. Now, there are some new rules related to short-term rentals, kind of like Airbnbs, that's talked about on page 412, 413. You can just sort of read through those on your own. Basically, it penalizes short-term rentals if short-term rentals are being provided in a city or municipality that does not allow short-term rentals. So we all know that sort of a lot of cities, sort of like the city of Vancouver, sort of banned, short-term rentals, Airbnbs, for example. So if you're sort of operating a short-term rental, but it's in a municipality or city that has restricted or banned short-term rentals, then these rules will basically severely restrict the expenses that you're allowed to deduct. So it's fairly straightforward. So I just sort of let you read those couple pages on your own. But what about CCA? Now, CCA we learned about in chapter 5. When you purchase a rental property, only the building portion will qualify for CCA, not the land portion. So whenever you buy any sort of real property, there's the land value and the building value. When you buy rental property, same thing applies. Only the building portion you can add to class 1 to take CCA on. The land portion you cannot take CCA on. Now, if you are an individual taxpayer and you buy the rental property partway through the year, the short fiscal period rule will not apply. And if you remember in chapter 5, we talked about that short fiscal period rule. You start a business partway through the year, you have to prorate your CCA. Well, if you buy a rental property partway through the year and you're an individual, you don't have to prorate the CCA. What we talked about earlier, only the building portion will qualify for CCA. Generally, it all goes into class 1, which is 4%. However, if the building is used 90% for non-residential activity, then you can use the 6%. Now, we kind of went through that in one of the earlier lectures. We looked at the different rates for class 1 buildings. Generally, if it's residential, it's 4%. If it's greater than 90% non-residential, meaning like it's like a corporate office, or you're using it to rent to corporations as non-residential, is used for office purposes, then you can get the 6% CCA rate. And we did sort of look at an example. We did look at the CCA rates table in one of the earlier lectures, where there was also a 10% rate for class 1. And that's if it's used 90% or more for manufacturing processing. But generally speaking, if you buy rental property and you're renting it out to tenants, individuals, is going to be class 1, 4%. If you're going to rent it out for commercial purposes to companies and 90% or more is for commercial rents, then it would go up to 6%. Now, for CCA purposes, each rental building has to go into a separate class 1 if they cost 50,000 or more. And the reason for that is, if you remember from chapter 5, when you sell a depreciable asset, you deduct the lower of cost or proceeds. Now, generally, because real estate will increase in value over long periods of time, even the building portion will probably go up in value as well, because usually the overall value is prorated between the land and the building. More goes usually to the land value than the building. But usually if the property increases in value over the time, the building value will also increase. If you're taking CCA on the building and you sell the building, you will have likely recapture. Remember, recapture you have to add to income. And so that's why each rental building that has a cost of 50,000 or more has to go into a separate CCA class. Because when you sell that rental property, there's a good chance that you will have recapture. And so that's why the building will have to go into a separate CCA class. You can't lump all your rental buildings into one CCA class, because then that might not result in recapture being recognized. And so we'll sort of go through an example that will look at calculating the CCA for rental buildings. Another rule with respect to CCA is that you can't create or increase a rental loss by claiming CCA. And we'll sort of look at that in our example as well. One of the things you have to sort of be aware of is the difference between repairs and maintenance. Those are usually expensed. So if you're just sort of fixing a leak, if you're just sort of doing some minor touch-ups, those amounts are considered repairs and maintenance, and those can be expensed. That's sort of different from if you were doing something to enhance the value of the building. If you were putting in, let's say, a brand new roof with much better material, not just restoring it to sort of the original condition, but you're sort of enhancing the value of the building by putting a new roof on that had sort of more protection, then generally that would be considered a capital expenditure, and you would basically have to add it to the cost of the building to the CCA class. So difference between repairs and maintenance, just sort of fixing something, not necessarily enhancing the value of the property. You can expense those amounts, but anything that will sort of enhance the value of the building, that has sort of a longer lasting sort of life, those are usually need to be capitalized, and you would add it to the cost of the building and take CCA on that. The example we're going to look at with respect to rental income is this one here. So Ms. Fox bought a duplex for $725,000. The land value is $150,000. The building value is $575,000. Now, even though it's a duplex, it's considered a single property. So there's sort of some legal duplexes and some legal duplex meanings that you can actually sell one side and keep the other. But this is sort of legally, it's still one property. So we're just going to treat it as sort of one property for tax purposes, even though there's sort of two units being rented here. So she bought the rental property in 2023, and both units were rented by the end of 2023. One of the tenants asked her to furnish the unit, so she bought some furniture for $18,500. During 2023, the total rents were $68,500, and the expenses before CCA totaled $28,000. So let's just sort of put the revenue and the expenses down first. So for 2023, the rents were $68,500. The expenses were $28,000. So the income before CCA is 40,500. And then we get into the CCA calculation. So this is good practice with respect to chapter 5. The building has a cost of 575. That's going to go into class 1. And the furniture and appliances, 18,500. That's going to go into class 8. And so once again, if you look on your CCA rates table, you'll see that the building residential use, so class 1, 4%, furniture and fixtures, class 8, 20%, 18,500. So let's set up the CCA classes. So we have the building goes into class 1, 575. The furniture and fixtures, class 8, 18,500. This is where chapter 5 comes in. Remember in chapter 5, we said that we sort of had those different periods of time. We had the period of time sort of before, what was it, November 2018, and then from November 2018 to the end of 2023. And we talked about the accelerated investment incentive. Because this addition was made in 2023, the accelerated investment incentive basically says that if you have any net additions, you're going to get them at 150%. So we get the original 100% of the additions, but we get an additional 50% of that amount for the first year of calculating the CCA. So 50% of 575 is an additional 287,500 for CCA purposes. Same with class 8, an additional 9,250. So remember that if the purchase of the depreciable asset was made during that period between November 2018, I'm just going to double check the dates here. I think it was November 2018. November, I forget the exact date, but yeah, it was November 2018 to the end of 2023. That's sort of when the accelerated investment incentive was at 1.5 or 150%. And then starting in 2024, it was just at a straight 100%. And remember, we talked about the half-year rule as well. An example we looked at last week was the half-year rule still applies to certain class 12 assets. But yeah, I found it in the textbook. The accelerated investment incentive at 1.5 or 150% was for purchases between November 21st, 2018 and December 31st, 2023. So once again, we add 50%. This is going to bump up the base amount to 862,500 for the building. And then for the furniture, 27,750. The CCA we can take then is going to be the 862,500 times 4% for the building, 34,500. And for the, just going to change this ratio here, for the furniture, it's going to be at 20%, and that's going to be 5,550. So we look at the total CCA. The total CCA is 40,050. And this sort of ties to what I mentioned earlier up here. You're not allowed to create or increase a rental loss by claiming CCA. So because we have income of 40,500 and the total CCA is only 40,050, we can deduct all of the CCA. And so our net rental income for 2023 would only be $450. Now, just to sort of finish off the CCA tables down here, we did the CCA calculation, but remember this 50% that we added, that was only done for calculating the CCA in that first year. So now we have to reverse it. So now we got to take it out. And the balance going into next year for the building and also for the furniture. And if you think about it, this 12,950 for the furniture, or is basically the 18,500 minus the CCA we took, 5,550. I think that's right. Double check that. Yeah, 12,950. And then for the building, once again, if you think about it, it's basically the 575 minus the CCA 34.5, and that's the 540,500 that we have left. Any questions about the 2023 year? Let's move now to 2024. Late in 2024, the tenants in the furnished unit moved out. So she didn't want to continue renting it on a furnished basis. So she sold the furniture to the tenants that were leaving for 14,000. The rental income generated for both during the year was 45,000. The expenses before CCA 32. So let's put the 45 and the 32 for 2024 here first. 45,000 was the rental income. The expenses were 32. So right now we have income before CCA of 13,000. Now the build portion, we can still take CCA on. So for the building, the CCA is basically going to be at 4%. So equals, so 4% of 540,500. That's 21,620. Now for the furniture, it was sold. Remember we said that whenever there's a disposition, we have to deduct the lesser of cost or proceeds. So whenever there's a disposition, I'm just going to put this over here. Whenever there's a disposition and we sold the furniture, we have to deduct the lesser of cost or proceeds. The cost of the furniture was 18,500. The proceeds of disposition was 14,000. So the lesser of the two is going to be 14,000. And if we do a quick subtotal here, we now have a negative amount. And so this again relates to chapter 5. If we have a negative amount at year end, which we do, we basically have to add that back into income. This is known as recapture. So we have to add this to income. And that will basically reset this to a zero balance. This amount that we add to income will go into our rental income because it relates to our rental income. So the recapture then, we're going to add, and if you notice, this subtotal here will now increase. It was 13,000, but because we're adding recapture of 1,050, our income before CCA will now go to $14,050. So even though we're looking at chapter 7, it does tie a lot into chapter 5. And that sort of ties to what I said back before the reading break. Chapter 5 is a very important chapter. It filters through many of these later chapters. And if you end up taking BFIN 451, the corporate tax course, it is sort of fundamental that you fully understand CCA calculations going into the BFIN 451 corporate tax course. Any questions to this point? Now, the question now is how much CCA can we deduct? We calculated CCA to be 21,620. But remember we said that we cannot take CCA to create or increase a rental loss. So we can't take that full amount. We can only take 14,050. That's the CCA we can take because we cannot create a rental loss by taking CCA. So we're not going to take the 21,620. We're going to take 14,050. And that will bring our net rental income down to zero. And so January 1st, 2025, the UCC will be the 540,500 minus the 14,050 CCA. So the balance going into next year is 526,450. Any questions about this rental income problem? I want to just talk a little bit about CCA as well. I just want to sort of remind you that CCA is a discretionary deduction. We can take anywhere from 0 to the maximum. There's also sort of a rule where it says that if you were trying to figure out which class to take CCA from, the rule says to take CCA from the lowest rate class first. So what does sort of that mean? If we sort of look at this example above here, let's go back to 2023. In 2023, we had a total CCA of $40,050. But let's say our net rental income was only 2,000. So let's say our rental income before CCA was only 2,000. So we can only take CCA of 2,000 to bring it down to 0. But we could take it from class 1, 2,000 from class 1, or 2,000 from class 8. The rule says always take it from the lower rate class, which is the 4% versus the 20%. Take it from the lowest rate class, because that way the balance in the higher rate class will be higher because you're not deducting the CCA from the higher rate class. So next year, the CCA deduction will be again larger because you save the higher rate class balance for future years. So that's sort of what this rule says, is that if you are deciding to take CCA and take it only from one or a couple of the classes, not from all the classes, always take it from the lowest rate class first. Therefore, you will sort of save your higher CCA deductions for the future. So to just give you more flexibility for the future, because you'll have larger CCA deductions in those future years. Any questions before we continue on? We're going to go through bonds. Now, bonds obviously was not my favorite subject in university, but it's talked about in chapter 7 with respect to how income tax deals with discounts and premiums. I'm going to get through the bonds before we take a break, just because bonds is sort of one of those topics that, once again, are a little bit sort of confusing. So I'm just going to go through some simple examples to just sort of refresh our memory about what is a discount, what is a premium. And then once we go through these 3 examples, then we'll sort of tie it into how tax rules applies to discounts and premiums. So let's look at this first example here. We have a 5-year, $100,000 bond, and the interest rate is 5%, and the interest is paid annually. Let's say this bond was issued at par. We have the borrower, who's also known as the issuer of the bond, they're the debtor. The holder of the bond is the investor or the lender. So let's sort of think about their cash flow. The borrower is going to get 100,000 when the bond is issued. At maturity, they're going to have to pay back 100,000. And if interest is 5% of 1,000, every year the debtor will have to pay interest of 5,000. From the investor or the bondholder's perspective, they're going to buy the bond. So they're going to pay 100,000. At maturity, they're going to get back 100,000. And then they're also going to get this interest income of 5,000 every year for 5 years. So that's sort of when the bond is issued at par. We learned in our accounting classes that sometimes the bond may be issued at a discount. So same thing, 5-year bond, $100,000 face value, 5% interest, 5,000 interest a year. But what if the bond was issued at a discount? Discount means less than 100% of the face value. So let's say this bond was issued at 98% or 98,000. The borrower or the debtor will only get 98,000, but they're going to have to pay back 100,000. And then every year they're going to have to pay 5,000 of interest. For the holder or the lender, they're going to buy the bond, so they're going to pay 98,000. They're going to get the 5,000 interest every year, but at maturity they're going to get back 100,000. So when we have a discount, this 2,000 difference basically is additional interest expense for the debtor or the borrower. They're only going to get 98,000, but they have to pay back 100,000. So this 2,000 is going to be additional expense for the debtor, but for the holder is going to be 2,000 extra revenue. So once again, just a simple bond example, just to refresh our memory about discounts and premiums. What about a premium? Let's say the bond was issued at 102%, so for 102,000. So in this example, we have a premium. The debtor or the borrower is going to get 102,000, but they only have to pay back the maturity or face value, which is 100,000. Once again, they're still paying interest every year of 5,000. For the holder, they're going to buy the bond by paying 102,000, but they will only get back 100,000. They'll still get the 5,000 interest every year. So with a premium for the debtor, they're going to get an additional 2,000. So that's sort of like additional revenue or income, right? For the holder, this is going to be a loss of 2,000. So once again, like an expense or like a loss. So just sort of quick overview of discounts and premiums. And any questions? Now, for tax purposes, so for accounting purposes, these additional amounts here, usually just sort of amortize them over the life of the bond. You can use straight line or effective interest, but basically you take that 2,000, you spread it out over 5 years. With effective interest, it's not going to be evenly over 5 years, but basically it's going to be spread out over 5 years. So for the discount up here, this would just increase the interest expense over the 5 years, a total of 2,000. For the premium for the debtor, this 2,000 revenue would basically reduce their interest expense over 5 years by a total of 2,000. So how does this tie to income tax? If you are the debtor and the bond is issued at a discount, that represents additional interest expense. Remember, for the debtor here, the discount represents additional interest expense. What the tax rule says is that it's either going to be fully deductible or only 50% deductible at maturity, depending on whether these conditions are met or not. If both of these conditions are met, then it's fully deductible. Otherwise, it's only 50% deductible at maturity. And we'll sort of go through this in more detail using an example. If it's a premium, if you are the debtor and it is a premium, that means you got an extra amount of money. In this example, you got an extra 2,000. If it's a premium, then it depends on who the debtor is. If the debtor is a money lending business, for example, a bank, then that premium is included in business income in the year the bond was issued. So if you're a bank, if you're a money lender, then that's basically your day-to-day business. So that premium you have to include in income in the year that the bond was issued. If you're not a money lending business, let's say you're just an individual who issues a bond to raise some money, but it was at a premium, for tax purposes, that premium has no income tax implications. It's going to be tax-free. So this, again, is a difference between accounting versus tax treatment. So I want to just sort of focus first on this one up here. What if you are the debtor? You're the one that basically issues the bond. You need to borrow money and is at a discount. Are these two conditions met? So let's look at this exercise here. Let's bring this over here a bit. So Moreau Limited issues a bond with maturity value of $1 million. The bonds pay interest. The annual stated rate is 4%. The bonds are sold for $985. So we know that this is a discount, right? The maturity value is $1 million, sold for $985. So we have a $15,000 discount. The effective yield is 4.57%. The bonds mature in 3 years. And so it just says, what are the income tax consequences for the bond issuer, Moreau Limited, who's the one that sort of borrows the money for those 3 years. And so Moreau is the debtor. They're the ones sort of issuing the bond. So they're going to get 985,000, but then they have to pay back $1 million. So that's going to result in a $15,000 discount. And so that's basically going to be sort of basically an expense, right? They're only going to get 985. They have to pay back $1 million. So we have this $15,000 discount, which is an expense to the company. What the tax rule says is that the $15,000 discount is fully deductible at maturity if the two conditions are both met. If not, only 50% deductible at maturity. So once again, what were these two conditions here? So let me just bring this up here. So these are the two conditions. So let's sort of look at the first one. The bond are issued for not less than 97% of the maturity value. So we're looking at basically the issue price, and we're comparing that to 97% of the maturity value, which is $1 million. And so that's going to be basically 970,000. So the bonds are issued for not less than 97% of the maturity value. So another way of looking at it is that rather than say not less than, it has to be greater than or equal to. So not less than, we could just sort of change that to greater than or equal to this amount here. So the issue price was $985. Is that not less than $970? It is not less than, but another way of looking at that is that is $985 greater than or equal to $970? So that first condition is true. And then the second condition, the effective yield. So they give us the effective yield. The effective yield is 4.57%. So basically it takes into account the discount is not more than. So another way of thinking about that is that must be less than or equal to 4/3 times the stated rate, which is 4%. So 4/3 of 4%. Oh, 4/3 of 4%. Getting wrong here. 4 divided by 3 times 4, 5.33%. So is the effective yield 4.57, not more than 5.33? It is. Another way of looking at that is the 4.57 less than or equal to 5.33? It is. So because both are met, Moreau will get to deduct 15,000 at maturity. If only one was met, they could only deduct half at maturity, so they can only deduct 7,500. But because both are met, Moreau will get to deduct all of it at maturity. Now with a premium, once again, it's a little bit easier. With a premium, it depends whether or not the individual or the person issuing the bond is a money lender or not. So let's sort of go through this premium example here. So we have the debtor or the issuer issues the bond for issue price of 102,000. So they're going to get 102,000 at maturity. They pay back 100,000. So we have this $2,000 premium. So this one's fairly straightforward. So basically says that if the debtor is a money lender, includes 2,000 in business income, year bond was issued. If it's not a money lender, then 2,000 is tax-free. So they would not have to include that 2,000 in any sort of income at all. And basically that premium then, because it's tax-free, would basically reduce their overall financing cost. Because if you think about what we have to do for accounting purposes, if we go back to the premium here, this is the one with the premium, and we have the debtor here. They basically get an extra, the 2,000. So that would just sort of increase their revenue, or another way of looking at it would be to reduce their interest expense. But for tax purposes, because it's tax-free, the 2,000, it would basically reduce their overall sort of financing cost. Any questions about the discounts and premiums with respect to bonds? So why don't we take a short break? We still have quite a bit to do, so let's just take a break. Let's just sort of take a short break. Let's come back at 7:42. So we'll just take a short break, 7 minutes, and I'll see you back here at 7:42. One thing I forgot to mention before the break was what about the holder or investor when it comes to bonds? So the two examples we did dealt with the debtor, the party that issues the bond. They're the ones that are borrowing the money. If we go back to our examples up here, once again, we focused on the debtor or the issuer. What about when there's a discount and we're the holder? We actually have an extra 2,000. What if there's a premium and we are the holder and we lose 2,000? So for the holder of the bond, it's a little bit easier. When we have the holder of the bond, they have a bond investment. They're buying this bond, and then at maturity, they get paid back. With a discount, that extra will be treated as a capital gain, 50% taxable, recognized as maturity. With a premium, they lose money, treated as a capital loss, 50% allowable, recognized at maturity. So pretty basic when it comes to the holder of the bond and how they deal with the discount and premium. It's treated as a capital gain when it's a discount, 50% taxable at maturity, premium, capital loss, 50% allowable at maturity. We're now going to move on to dividend income. And this relates to individuals. So corporations do different calculations. We're just going to focus on how individuals calculate dividend income for tax purposes. Now, in dividend income, there's going to be two types, non-eligible and eligible. In this course, you'll be told what type of dividend it is. If you take BFIN 451, the corporate tax course, then you'll learn about what are non-eligible dividends and what are eligible dividends. So we're not going to get into the discussion about what determines if a dividend is non-eligible versus eligible. In this particular course, 351, we'll be told what type of dividend it is. But before we get into the actual calculation, I want to explain why we have special rules for individuals when it comes to calculating their dividend income. We're just going to compare two scenarios here. Let's say we have a sole proprietorship who is earning $100,000 in business income. Now, we're going to assume that this individual has a tax rate of 43%. That's their combined tax rate, federal and provincial. Now, when we started this course, I said, we're only going to be concerned about the federal tax and the federal tax credits. But when it comes to dividend income, we do sort of have to incorporate provincial tax as well. So in this example, we're going to assume that both their federal and provincial tax for this individual is going to be taxed at 43%. So if they have 100,000 in business income and they pay 43% tax, that's going to be 43,000. The amount that they will have left after tax will be 57,000. So that's if they were operating as a sole proprietorship. Now, sometimes a sole proprietorship might decide to incorporate. So let's say they decide to incorporate, and now the corporation earns the 100,000. The corporation pays 27% combined federal and provincial tax. So in this example, we're assuming that the individual decided to incorporate. The corporation will now be the one that makes the 100,000. They pay tax of 27%. So the amount that the corporation will have after tax will be 73,000. And now they'll pay that $73,000 dividend to the shareholder. And so that shareholder will now have dividend income of 73,000. So I'm going to show you what would happen if there was no special rules with respect to dividend income. So if there was no special rules with respect to dividend income, this individual gets 73,000 from the corporation that they're a shareholder of. They're going to pay tax at 43%. So 43% of 73,000 is 31,390. The amount they would have after tax would be 41,610. And you can sort of see here that if they were to incorporate and there was no special rules with respect to dividend income, there would be no incentive to incorporate because they would have a lot less after tax if they decided to incorporate, have the corporation earn the 100,000 and then pay the after tax amount to them, the shareholder, as a dividend. So that's why we have special rules with respect to dividend income. Because if you think about it, the corporation has already paid some amount of tax. So it's kind of unfair to have the individual sort of pay this huge amount of tax when the corporation has already paid some tax of the profits that originated of where the dividend originated from. So that's sort of why we have special rules with respect to dividend income, because if there was no special rules, there would be no incentive to incorporate. So we don't do this if we're an individual receiving dividend income. So what do we do instead? So let's just sort of look at what the rules are. So we're still going to get the 100,000 earned by the corporation. So let me just sort of do it over here. So this part will still be true. The corporation will still pay their tax, and they will now basically distribute a dividend to the shareholder for 73,000. So the individual shareholder receives 73,000 dividend. Now remember I said there was two types of dividends. These dividends will be eligible dividends. You'll be told what type of dividends they are. The individual then will basically take the 73,000, the actual dividend of 73,000, and then they have to gross it up. And this is where I'm going to take you to the rates table. So let me bring up the rates table quickly. So remember these rates table that we used a lot in chapter 4? If you scroll down, page 1, page 2, page 3, page 4, page 5. Top of page 5, dividend gross up, dividend tax credit. Eligible dividends are grossed up by 38%, and the federal dividend tax credit is 611 of the gross up. Non-eligible, grossed up by 15%. The federal dividend tax credit, 9/13 of the gross up. So because we're told the type of dividend they will be, we're either going to use eligible or non-eligible. We're told that these are eligible. So we have to gross up the 73,000 by 38%. We'll talk about the dividend tax credit in a moment, but the dividend tax credit for eligible dividends is 6/11 of the gross up. So we'll keep that in mind, and we'll take us back to the Excel spreadsheet. So these eligible dividends, we have to gross them up by 38%. So equals this number times 0.38. And so we have to add 27,740 to this amount. This is known as the taxable or grossed up dividend. And so this amount gets included in 3A when calculating net income for tax purposes. This amount is trying to replicate the corporation's pre-tax income, which is 100,000. So it's not going to be dollar for dollar, but that's why we do the gross up. Because what we're saying is that this $73,000 dividend originated from a pre-tax amount. And so our estimates for the pre-tax amount will be basically using the gross up. And so the estimate of the pre-tax amount was 100,740. We are now going to apply the individual's tax rate. So the tax rate for this individual is 43%. So we're going to multiply this by 43%. And the amount of tax that will result will be 43,318. So I'm just going to round this to the nearest dollar. So this is the total federal and provincial tax before the dividend tax credit. Dividend tax credit is usually abbreviated DTC. So that's a lot of tax, right? Because remember we said over here that 31,390 was already a lot of tax. Well, this is even more. But all we're trying to do is say the dividend originated from a pre-tax amount. We want to figure out what that pre-tax amount is, an estimate, and then we're going to apply your individual tax rate. If you have a higher individual tax rate, you're going to pay more tax. If you have a lower individual tax rate, maybe 29%, then you'll pay less tax. And then what we're going to do is we're going to give you a dividend tax credit. Because we're looking at both federal and provincial tax, there's a federal dividend tax credit and a provincial dividend tax credit. The federal dividend tax credit, that was given on the rates table. If you remember, that was 6/11 times the gross up. The gross up is 27,740. Remember, the gross up is this amount up here. Now, the provincial dividend tax credit will vary from province to province. So if you're asked to do this, you'll be given the provincial dividend tax credit amount because it varies from province to province. But let's say for simplicity's sake that this is 5/11 times the gross up. I'm just making this really simple. It's not usually going to be this simple, but if you think about this, 5/11 plus 6/11, that equals 11/11. So they're sort of going to get all that 27,740 as a tax credit. So if we just sort of break it down, 6/11 times 27,740, that's going to be about 15,131, and then 5/11, that's going to be about 12,610, yeah. Yeah, 27. I guess it's a little bit over the 27,740. Did I round it properly? Let me see. One, 5 divided by 11. Oh, this should be 12,609. Sorry, 12,609. Yeah. Yeah, so that equals a total of 27,740. This dividend tax credit is supposed to represent the amount of tax that the corporation paid, an estimate. The tax that the corporation paid was 27,000. So that's what the dividend tax credit is supposed to represent. And so when we think about the net federal and provincial tax, we're going to take the 43,318 minus the dividend tax credit. So the tax that will be paid, oops, hold on, that's not right. Is 15,578. So the 43 318 minus the dividend tax credit. This is the total tax that will be paid. And if you think about it, how much will the individual have after tax? They got this $73,000 dividend. They're paying $15,578. So the amount they'll have after tax is going to be $57,422. And if you look at that, that's going to be a lot more comparable to if they stayed as a sole proprietorship. If they stayed as a sole proprietorship, they would have 57,000 after tax. If they incorporate and pay themselves a dividend, they would have 57,422. So basically, there would be comparable results. And so there would be sort of no major tax difference. And that's sort of why we have these rules, because the government wants to sort of take income tax out of the decision whether you incorporate or not. Now, generally tax does come into play, but that's sort of the whole sort of originating premise of why there was these special rules, just to sort of make things more fair if you decide to incorporate, and then try to sort of remove income tax out of the reasons why you would want to or not want to incorporate. So there'd be sort of no big difference between whether you stay as a sole proprietorship or you decide to incorporate. Any questions about this example? Now, once again, if you were given non-eligible dividends, then you would use the percentage gross up given for non-eligible dividends, and for the dividend tax credit, you would use whatever fraction was given on the rates table. So you would just sort of follow the same process, but for non-eligible dividends, just use the amounts on the rates table with respect to non-eligible dividends. What we're going to do then is we're going to go into this example here, assignment problem 7.4, and this is going to compare these three sisters and what their after-tax amounts will be if they decide to invest in bonds versus dividends. So let's have a look at this one here. So if you notice here, they started talking about these three sisters, and then they changed the names down here. So we'll just use Cindy, Charlotte, and Carol. And so Cindy, Charlotte, and Carol are three sisters, and they have different marginal tax rates. So we have both federal, provincial. Cindy is at 22%. Charlotte is at 20, 30, 40%. And Carol is at 54%. And so because we're looking at dividends, we're going to be using both federal and provincial amounts. In 2023, their parents died, and so they left them each with $100,000. So after the estate was settled, each sibling received $100,000. They can either each invest it in bonds that will pay 6% interest, or in shares that they can buy for $50 a share, and the shares will pay an eligible dividend of $3.25 per share. So let's start with the bonds first. The bonds is pretty easy. If they take the 100,000 and they invest it in bonds, they're going to get 6,000 of interest income every year. So let's look at the calculations for each of these sisters. They're going to get 6,000 in interest income. So each sister, if they invest in bonds, they're going to get 6,000. Their tax rates will be different. So this will be 22% tax. So 1,320 in tax. 40% tax would be 2,400, and then 54%, 3,240. So let's just sort of figure out how much each sister will have after tax if they decide to invest in bonds. So 4,684 Cindy, because she's in the lowest tax bracket. 3,600 for Charlotte. She's in the 40% tax bracket. And then Carol will have the least because she's in the 54% tax bracket. Well, that's pretty straightforward. Now, if they invest in the shares, we need to sort of figure out how many shares they can buy. So they each will have $100,000. Each share will be $50. And so that's going to result in 2,000 shares for each sister. The shares pay 325 eligible dividends per share. So the total eligible dividends will equal 2,000 times 3.25 will be 6,500. So with each of the sisters now, we have to calculate, first of all, what is their taxable dividend? So remember the taxable dividend, all we're going to do is take the actual dividend, 6,500. And remember for eligible dividends, it's an increase of 38%. So 2,470. So the taxable dividend or grossed up dividend will be 8,970. And once again, that's the amount they include in 3A. Because remember, in 3A, they include positive amounts of property income. So the taxable dividend is what each sister will have to include. Now, this is going to be the same calculation for each of the sisters. Because once again, they're all going to get 100,000. They're all going to invest in shares. They will each get 2,000 shares. Each share will pay 325. So each sister will get 6,500 in actual dividends eligible if they invest in the shares. What will be different is their tax amount before the dividend tax credit. So remember, Cindy is taxed at 22%, Charlotte at 40%, and Carol at 54%. So the tax, federal and provincial, before the dividend tax credit for Cindy will be 1,973. For Charlotte, it's going to be 3,588. And for Carol, just sort of round it to the nearest dollar, 4,844. And so what you see is that the rates, the amounts differ because Cindy is in the lowest tax rate compared to the other two sisters. So she's paying a lot less tax compared to Carol, who's at 54%. So this is sort of what I mean. This taxable dividend is supposed to represent the corporation's pre-tax income. And so we estimate what that is using the gross up, and then it gets applied to your individual tax rate. So if you are at a higher tax rate, you will pay more tax. If you are at a lower tax rate, you will pay less tax. But the taxable dividend amount will be the same for each sister. Any questions so far? And then we have the dividend tax credit. And remember with the dividend tax credit, there's a federal amount and a provincial amount. The federal amount is the same. That is 6/11 times the gross up. The gross up is 2,470. Now the provincial amount, if it's required, will be given to you because it changes from province to province. So we go back to the question. We're told that the provincial dividend tax credit on eligible dividends is 25% of the gross up. So sometimes they'll give you a fraction, like I did in the previous example, 5/11, or they give you a percentage. This one, they give us a percentage, 25% of the gross up. So Provincial then one will be 0.25 times the gross up, 2470. So if we think about this, 6/11 times the gross up, this is going to be 1,347, and then 25% of the gross up is going to be 618. So if we add those two together, the total dividend tax credit is going to be 1,965. Let me just sort of put that as a minus sign. Now, sometimes you can sort of combine the calculation because both of them are being multiplied by the gross up, right? So another way of sort of doing this, if you're looking at trying to just do it quicker, you can just go 6/11, put that into your calculator, plus 0.25, and then take that number times 2,470. So if you did that on your calculator, 6/11 plus, so that's 0.5454 plus 0.25, just total that, you get about 79.7954545 times the 2470. That will also give you 1,965 rounded, of course. Now, this dividend tax credit will be the same for each sister. Because remember, the dividend tax credit is based on the gross up, and the gross up was the same for each sister. So the taxable dividend is the same for each sister. The dividend tax credit is the same for each sister. The only difference was their individual tax rates, which resulted in a difference in the amount of taxes that will be paid. And then we get to the tax after the dividend tax credit. So for the first sister, she's going to pay very little tax because of the dividend tax credit and because she had a low tax rate to begin with. So these are the tax amounts that each sister will have to pay, and then we'll figure out how much they will have after tax. So we're just going to take the actual dividend of 6,500 minus the tax amount. So 6,500 minus the tax for the first sister, 6,492, because remember, she only had to pay $8 tax. For the second sister, 4,877. And for the third sister, who's in the highest tax bracket, 3,621. And so what you can sort of see here is that they want us to sort of compare the after-tax amounts between the share investments, which will pay dividends, and the bond investment, which will pay interest. And what you'll see is that for each sister, they're better off with the share investment because they're going to have more after-tax cash if they invest in the shares. But that's just sort of assuming that they do get the dividend income. Those of you that are obviously, or not obviously, those of you that are maybe taking financial planning, you know that dividend income is riskier than interest income because interest income is more or less guaranteed, whereas dividend income could vary from year to year depending on the profitability of the company. So there's a lot more risk when you invest in shares. Also with share prices, they could go down in value, so it may lead to a loss in your initial investment. Whereas with the bond investment, you're once again not 100% guaranteed, but a little bit less risky, better chance that you'll get the $100,000 back at the maturity. So there are more risks with respect to share investment and dividend income. But if you sort of put that aside, generally speaking, the investment in the dividend, in the assets that pay dividends will be better when it comes to tax implications. You end up paying less tax, and so the after-tax amount will usually be higher. Any questions about these calculations with respect to the dividend income? So it is sort of a unique set of calculations. So once again, when you're preparing for the midterm, use the textbook exercises, use the self-study problems to sort of help you sort of understand these calculations. They're very systematic. They're not, hard once you just sort of have the steps in front of you, but you will be told whether it's a eligible dividend or non-eligible. And if you're required to do the provincial calculations as well, you'll be told the sort of the provincial tax or the combined tax rate, and you'll also be told what the provincial dividend tax credit amount is as well, what percentage of the gross up it is. The dividend income, once again, if you don't really understand the reason why we have the rules, it's kind of hard to sort of grasp. That's sort of why I went through this example here, just to sort of give you some sort of background of my own experience. Um, when I sort of learned these rules in university, I basically just sort of memorized them. I never really understood why we had to do them. And it wasn't until I started working in public practice that one of the senior accountants sort of explained to me why we do the gross up, why there's a dividend tax credit, what's it supposed to represent. And then it made a lot more sense. So just sort of something to keep in mind, whether you're pursuing a career as a CPA or a financial planner, the sign of a really good tax advisor, whether they're in financial planning or in accounting in a public accounting firm, is one that can explain these tax rules in a way that an average taxpayer who has no tax background can really understand. So always sort of think about developing those soft skills as you're sort of progressing through university and as you're starting your career once you graduate. Those soft skills will be setting you apart from your peers. Um, the communication, both verbal and written, will be really helpful to have once you embark on your career after university. Any questions about this question, first of all? I want to just bring up eLearn quickly. I think that was it for here. I'm going to bring up eLearn. There's also one of the students also wants to sort of talk about one of the events coming up, but we'll do that after I bring up eLearn. So let me bring up eLearn quickly. So next week is the midterm. So make sure you get your chapter 7 homework done by Sunday night. The midterm next Wednesday will start at 6 o'clock. It'll be 2 hours. The exam, again, will only move forward, so make sure you budget your time properly. There's no need to be on Zoom, but make sure you're logged into your CapU email. 11 multiple choice questions followed by 4 problems. There will be a comprehensive CCA problem that I have sort of right there. Kind of, multiple years, meaning kind of like what we did with that rental question that we just did before the break. It started in 2023. We had to do the calculations for 2023 and then in 2024. So that sort of type of CCA problem covering multiple years, where we buy the asset in 1 year, maybe we sell some of the assets the year after, kind of like we did with the furniture. So practice those types of CCA problems when you're studying for the midterm, and it will cover chapters 5, 6, and 7. Once again, no need to be on Zoom, but I will be on Zoom for the first 10 minutes. So if you do have any technical issues, which generally there never has been any issues with eLearn for exams, but I will be on Zoom for the first 10 minutes in case you have any technical issues, just jump on to Zoom. If you have any questions while you're studying, feel free to reach out by email. If we can't resolve it by email, we can always set up a short Zoom session as well. So once again, use the self-study problems, use the textbook exercises to help you get ready for this midterm. Generally, the second midterm is more challenging than the first midterm, but as long as you prepare, and once again, by prepare, do the actual exercises, do the actual self-study problems. Don't just review what we did in class. You actually have to do the problems under exam conditions to really understand how these problems are solved. Any questions about the midterm? So the last thing that I want to talk about, let me just double check my list here. There was just the one more item. Where am I here? Not here. Yeah, the last thing was Justin. Justin, are you able to just sort of unmute? Justin is with the Capilano Accounting Association. And Justin, if you want to just sort of talk a little bit about the upcoming events for the Capilano Accounting Association.
Awesome. Thank you, Ronald. Yes, like Ronald said, I'm part of the Capilano Accounting Association. I know I've spoken to a few classrooms and quite a few of you are already heard me speak, but we're hosting a spring networking event on March 13th in the library 321 and 322 at 6 p.m. This is our big spring networking event. There's going to be door prizes and food and drink for the students attending, but we have almost all of our sponsors coming to this event, and they are in the middle of spring recruit, so they're actively hiring for internships next summer, and a few are trying to fill some spots for this upcoming summer. So it'd be a great opportunity if you're looking to just speak with recruiters, and there'd be some CPAs there as well to learn about their firms. It's a really great opportunity for students at Capilano. So we'd really appreciate it if you sign up and come out to network and help get your career ahead. Thank you, Ronald.
Any questions at all for Justin before we wrap up? Do students have to register, Justin?
Yes, yeah. So if you scan the QR code there,
Mhm.
it just gives us a better idea of numbers, how much food we need to prepare, and name tags, so the recruiters know who you are when you show up.
What about students that have never been to a networking event? What should they expect when they arrive? What should they sort of aim to do while they're there, Justin?
Yeah, so it's kind of, we're gonna have open booths. So each firm is gonna have a table in the classroom, and they'll have their banners and their two representatives at the table. And it's really, you go up to them, you introduce yourself, and you just ask about their firm, and they're very welcoming people. They do a lot of recruiting events, so they ask you quite a bit of questions. They're very easy to talk to. They want to learn about you. It's for the firms to put a face to a resume. So when you apply to their positions, they're like, oh, I've seen that person at the Capilano networking event. They're really nice to talk to. A lot of the times they ask you about your life and your interests, and then it kind of goes. The conversation goes towards what's it like to work at their firm, what is it like to be an intern at the firm, and sometimes they're there if you have career questions. They're great with those too.
One thing that I would suggest to students if you're attending this event is try to make yourself stand out. It's going to be, like Justin said, they're going to try to get to know you so they can sort of put a name to a resume when the resume comes across their desk. And so think about things that you're doing either at university or maybe outside of university that will make you stand out. Just to sort of give you an example, about maybe 10 years ago, I taught a student BFIN 351 at Capilano, and she did she had a side business baking cakes for customers. And so on her phone, she had all pictures of all these cakes that she decorated and baked and sold to customers. And so she went to the networking event. They asked her, oh, so what do you do? And I said, oh, I have my own cake making business. Here's some pictures of these cakes that I sold. And it really made her stand out. So she even said that the recruiters coined her as the cake lady. So they knew her name, they knew her as the cake lady. When they saw her resume, it sort of rang a bell as to who she was. It wasn't just sort of who is this student's name on this resume. And so think about things that maybe you are doing, maybe hobbies that you're doing, things that you're volunteering for that make you stand out when you're talking to these recruiters, because that's how they will remember you. Another student told me, well, actually, was it a student? Another recruiter told me that what they will sometimes do, and I don't think are business cards that common anymore, Justin, at these recruiting events for students to hand out?
usually recommend that you have your QR code on LinkedIn
Okay.
or your scan on LinkedIn.
Mhm.
A lot of times the recruiters will have a QR code where you can connect with them and they post updates on their recruitment process.
Okay, so that's a great idea. Yeah, because QR codes on LinkedIn is becoming a lot more common now. What I heard from another recruiter is that sometimes they will meet with students at these recruiting events. One will sort of catch their eye. They'll write their name down or, somehow make a note of it and put it into one pocket. And the students that don't really fit, they'll put their names down, put it in their other pocket. So the recruiters, yes, they're there to represent the firms and they're there to help you sort of understand a little bit about their firms. But really, they're looking for students that will fit their culture and their firm. So you've got to make a good impression because it could be the difference of whether your name is put into the pocket that they want to see when it comes to interviews or the pocket of names that they don't want to see when it comes to interviews. So, definitely go out and try to find out a lot about these firms. But at the same time, it's sort of their first chance to gauge who you are. And if you make a good impression, then you'll be sort of that much ahead when it comes to the actual recruiting and the actual interview process. Any questions at all for Justin about the recruiting event? So again, I really think it's really important to attend. So even if you're not sure whether you're going to go into accounting, maybe you're in the financial planning stream, but you're thinking, well, maybe it might be a good idea to keep accounting open as an option. Go to the recruiting event because you just never know. And if anything, it will sort of build your soft skills. A little bit about my background. I did get my CPA. I worked at KPMG, but while I was working at KPMG, I also got my CFP designation as well. So I did have both designations, both CPA and CFP. So it just sort of opens up more doors, even if you're not sure whether accounting is for you and you're thinking financial planning might be more up your alley. Go to the recruiting event, keep your options open, and maybe in a few months' time, you'll think about switching to accounting. And so going to this networking event, um, good to sort of build the soft skills and also to still build the networking skills because you sort of never know when those connections might come into play. Thank you, Justin, for your presentation. And I don't see any questions. So that is it for tonight. So once again, don't forget about the midterm next week and feel free to email me if you have any questions while you are studying. Okay, everyone, that is it for tonight. Have a good night and good luck with your studying. And